Welcome to Excel and Finance video number 10. Hey, if you want to download this workbook, click on the link below the video and you can download this workbook. And if you're in the class, go to our class website. Hey, we're in chapter 2. We just talked about the balance sheet, working capital, market value, and a number of other things. Now we need to talk about the income statement. Now the income statement is different than the balance sheet. It shows accounts. It shows revenues, expenses, net income for the whole period. The balance sheet showed us just for a particular day. So if we look back at our balance sheet, right, it was as of December 31st. 2 years here, so 2 columns. Just one day, but forget it. The balance sheet shows us the whole period. Whatever it is, it could be a year or month or whatever period. And let's just take a look here. We have some notes. The first thing is the amounts that the business earns. Could be called revenue, sales, or net sales. Now, in accounting, those can be very different, especially net sales and sales, right? Sales are the $100 you get for the shoe, but net sales are subtracting any returns. But again, in finance and in this textbook, sometimes these words are interchangeable. But nevertheless, revenues are amounts earned by a business from delivering a product or service. The moment you hand over the shoes to the customer, or you give the completed tax return to the customer, or even baseball, you buy season tickets, that baseball team doesn't actually earn the revenue or get to record it until they deliver. So until you go to the game, right? Okay, so when the product is delivered, that's when you can record the revenue. That's actually called accrual accounting. Accrual accounting, actually, let's go over to this sheet right here, accrual. It means for revenue, it means record or recognize a revenue when it has been earned, regardless of when the cash is received. So think about it. If you buy baseball season tickets and you give them all the money up front, the cash went in, but they're not allowed to record it on the income statement till later. Same with an expense. Meaning of expenses, record or recognize an expense when it has been incurred, regardless of when the cash is paid. So that means if you pay the cash, you can you get the bill, you pay the cash, then the expense and the cash are the same. But if you get the bill, and businesses get bills all the time, and it sits, as soon as you get the bill, you have to record it on your balance sheet because you know that you owe that money. But if you don't pay it for 30 days, there's a disconnect between when the expense is recorded and when the cash comes in. For us, in this textbook in the finance class, we'll only have a discrepancy between when the cash moves and when we record the expense for depreciation. All right, so accrual accounting. By the way, that's what it's called, accrual accounting. You know who invented accrual accounting? Elvis, right? Don't be a cruel. No, not really. It was actually 600 years ago. The Venetians, and then a Franciscan monk named Luca Pacioli wrote a book about accrual accounting, not Elvis. All right, so the income statement, you can see right here we have depreciation. This is the one where accrual accounting is going to say, hey, we have to record this in this period, but maybe the cash is not expended in this period. So we will have to talk about that coming up. We'll see some calculations that involve converting this potentially non-cash expense to a cash or non-cash expense. Sorry, non-cash expense. We'll have to take that in consideration when we do calculations. So the income statement, profit and loss for a particular period. Here it's for the whole year. We have our net sales, cost of goods sold. This is like when you sell a shoe, your customer gives you $100. If you paid $50 for it, the cost of goods sold was $50. By the way, these sales, as we mentioned on the balance sheet, let's look up here. It could come in the form of cash or credit card receipts or accounts receivable. That means we'll collect from the customer later. Also, with cost of goods sold, we could also pay cash for that shoe, or we could have accounts payable on our book for cost of goods sold. So we have cost of goods sold. Depreciation, I'll actually show you how to calculate in just a moment. Then we have our earnings before interest and tax. So really what we're doing here, if we're doing an Excel formula, we're going to take the revenue and subtract both of these expenses. So whatever the revenue is, this earnings before interest and tax is going to be a lot less. Then in this class, not in accounting, we're going to list the interest paid, always right after it, $76. And again, taxable income is going to be earnings before interest and tax minus our interest paid to get our taxable income. Then we're going to have to calculate taxes. Remember we mentioned earlier interest paid and taxes are usually called things like interest expense and taxes expense in accounting. But for us, that's the way we list them. Taxes paid. In this particular example, we just have it here. Coming up in the next video when we do our cash flow analysis, I'll actually show you how to calculate taxes. Finally, we get our net income. Whatever the taxable income minus our taxes, we get our net income. And this is pretty much the form of our income statement throughout this whole class. Now dividends, what are dividends? Well, first off, net income, that's the profit or earnings or net income. Those are all synonyms. It can go one of two places. So we have in the millions, right? 410 million, the RAD Corp made for this year. It can go one of two places. You can either pay it out in cash to the owners, that's called a dividend, or you can keep it and plow it back into the business and buy more assets. Businesses like Microsoft in the early years never paid out dividends. Why? Because they had all sorts of, they wanted to take their profit, plow it back into the company, and make investments to grow their company. Eventually, all companies at some point have to pay out some cash. Even Microsoft finally did. Nevertheless, it can go two places: dividends or addition to retained earnings. So as we saw on the balance sheet, let's go look at this. On the balance sheet back here, we saw common stock in and paid in surplus, and we saw retained earnings. Now we understand the meaning of retained earnings. Since net income is a synonym, I'm going to go back over to the sheet right here. For earnings, it just means the earnings that we've kept. Retain means to keep. All right, so we're going to make this calculation, and pretty much throughout the textbook we'll have to make calculations. We'll know our net income. We'll subtract our dividends, and boom, that's how much the company is keeping to plow back into the company. All right. We'll also occasionally have do calculations involving the total number of shares. This means as of this particular date, we have 210 million shares outstanding, individual stocks. So then we can make a calculation like earnings per share. This is a very important measure. We'll talk about it a lot next chapter, but I just want to show you a calculation here. This is like an estimate, right? If we took all the net income and chopped it up and gave it out to all of the shareholders, how much would it be? This is in millions, this is in millions. So we can simply make this calculation. Earnings, or net income, divided by the total number of shares. So if we were going to give it all out, that's what we give out. Each owner would get $1.95. But that's not the case. They kept some of it because, and usually if they're keeping a lot of retained earnings, it's because they have some good ideas. They want to invest it and make the company grow. But dividends, we can easily make dividends per share. Those total dividends in millions divided by our shares. So that means in this particular year, each, if you had one stock, you got 42 cents. All right, we got to talk about depreciation. What is depreciation? We saw it here just as a number, 71. It was an expense. Let's go over here. I wasn't supposed to have that there. Let's just delete that. So UPS truck cost, we bought a bunch of them, right? $5 million. Salvage value, what's that? Well, in accounting, you have to take into consideration that you might be able to sell them, even if it's scrap value. Notice it's its salvage value, right? At the end of its useful life, you're going to do something with them. A lot of times it's 0, so you just put a 0 there, right? Control Z, but this is 250. We have to take that in consideration when we do depreciation. We also need to know how many years the asset is going to be used, in this case a truck. So 10 years, we'll estimate. That's an estimate. This is just a simple straight line depreciation. There's lots of ways to depreciate. And here's the calculation: cost minus salvage divided by years. And we're going to have to remember our order of operations. Open parentheses to force the subtraction first. 5 million minus 250,000 divided by our 10. And this gives us the yearly depreciation. Now let's think about this. The cash went out the first year. And it doesn't matter whether we borrowed lots of money or what, but we had to pay someone the cash. Even if it was a short-term loan, we're assuming that first year we paid out $5 million. So that's the cash. Remember, in financial management, we're interested in cash, not accounting income, expenses, or revenues, but actual cash. So there's a disconnect here. If this is the depreciation expense for each year, and we're going to take this expense each year, then that means there's no cash associated with it. It all went out the first year. Okay, let's see an example. I'm going to go over to the accounting sheet, and we're going to talk about the matching principle. This is the reason we have accrual accounting, why Elvis invented accounting. No. Let's look at this. So I just have a $1 million UPS truck here, salvage value, 5 years. So there's our yearly depreciation expense. Now, if we didn't do depreciation like this, what would we do? We have 5 years, and actually this right here, let me get rid of that. 5 years. We have assumed that this truck is going to last for 5 years. Well, think about this. If we have it around for 5 years, that means it's bringing in revenue each year. So every year we use these trucks, and we're making all these deliveries, we bring in this revenue. So each year we have these revenues. Well, what are we going to do? If it's $1 million here, here's the income statement. This is what you could do if you didn't have accrual accounting. You just say, oh, there's the revenue. Man, we spent $1 million on that right there. So I'm going to take that $1 million in this first year. Right? So what would happen to this first year simplified income statement? Revenue's $1 million. $1 million cash went out for all the trucks. Other expenses were $1 million too. So we'd have a big, huge loss here. But look at this. The rest of the years, we'd have to record nothing because cash went out the first year. We recorded it here. Forget it. But what that means is we're not properly matching. If the assets last in this many years and it's generating revenue all these years, accountants have to match each one of these revenues with the expense. And that's why we, in essence, chopped it into 5 pieces. So it's not this. It's actually $180,000 each year. And actually, this should have been equals this minus that. So it actually should have been 900,000. Instead, we need to put one of these. Now, here's what happens if you don't have the matching principle. And this is why accountants do it. The first year we have a gigantic loss. So in essence, if you're looking at the income statement, that should be a simplified net income or simplified earnings or something, just to illustrate our point here. Totally much too small. We haven't accurately portrayed this, but the rest of the years it's looking great, right? Because we have no expense here. Anyway, it's not allowed. It's the matching principle that says we must match all of the expenses to the revenues. So now I'm going to change this. I'm going to go 180,000. Now, in chapter 00, we learned if we want this number in each one of these cells as we copy the formula over, we need to lock this. So I'm going to hit the F4 key and Control Enter and copy the formula over. And now we properly have matched our expense to the revenue. Now, the way it works is we buy the asset, it generates the revenue, and then we assign the proper expense. All right, now why do we talk about all that? Because in this class, throughout the entire textbook, we're always going to be talking about non-cash expense. So it's helpful to know why we do this. All right, but now what are we going to do? Matching principle just says be sure to match all your revenues to your expenses. Let's go back over here, depreciation and our income statement. So now we know 71 is listed on the income statement, but there's no cash associated with it. Let's go see the implications for what we're going to do in this class. Over here, there's a sheet called NCS, Net Capital Spending. I should have put that up here, or I'll write this right here. Oh, there it is, net capital spending. We are going to have to calculate a cash flow from our accounting numbers. Balance sheet net fixed assets as of December 31st, 2009. So we have the begin number. Remember, if it's December 31st, 2009, that's the amount, 500K, that starts on January 1st, 2010. And here's the ending balance. So it looks like we went up by $150,000. This is the balance sheet, and this is net. This is minus any depreciation. All right? So net capital spending, if our job as the financial manager is to look at the financial statements and figure out how much they spent, and net capital spending, if they're buying assets and they're smart managers, usually that's a good sign, because it means they have some good ideas. They're trying to grow their business. Well, let's go ahead and do this. Equals the 250,000 here, end value, minus our begin value. That gives us the difference. But guess what? We have a non-cash expense. Remember, this says net, so this actually has the depreciation in it already subtracted. So we need to add it back in. We need to actually go plus this right here, and that will actually give us the cash flow associated with net capital spending. So there it is, 256,000. This is just one of many cash flow calculations we're going to make from accounting information into good, useful cash flow financial information. Let's look at another example here. This one's slightly different situation. Oh, the end value is 350, but the begin was 500. So it looks like we're dramatically reducing our assets. Let's go ahead and make the calculation. We take our end minus our begin and then add back that non-cash. That's already recorded. That depreciation is in the net fixed assets on the balance sheet. Now, minus 125,000, whereas here it was 265. So here, you assume that if they're increasing their assets, they have some good ideas and they're trying to grow their business. But here, this could be a sign of trouble, right? If they are so strapped for cash, they've tried to take out short-term loans, or they've tried to, sell their inventory, collect their accounts receivable, and now they're, selling long-term assets. That could be one reason. Again, these numbers are things you can calculate, and they can be triggers for investigation. You got to go find out why. But this, in general, is probably not a very good sign. Maybe they're downsizing, right? But for whatever reason, it's a negative. Most of the time, in a healthy business, you're going to see our depreciation. We talked about the matching principle. We did our net capital. Actually, one other topic that we kind of touches on in this chapter, but we never really come back to it. It's just kind of a warning for those of you that are going to go on and do finance. Again, accounting information has accrual accounting, and there's sometimes where accountants record things as product costs and period costs, but really in finance you usually want to see variable costs and fixed costs. Variable costs just mean if you are manufacturing boomerangs, every time you make a new boomerang, you're using a little bit more wood, a little bit more paint. Variable cost. Variable cost depends on the number of units produced. Fixed cost is like the rent or executive salaries. And those things can be fixed over a certain period. And we'll talk about this a lot later in chapter 7 or 8, I think it is. These are the kind of costs we would like to see, but sometimes accountants record product costs and period costs. What this just means is product cost, for example, could be cost of goods sold. If you're actually a manufacturer, sometimes they mix variable and fixed costs into the product, right? So if you're a boomerang manufacturer, which I used to run a boomerang manufacturing company, the wood, that's a variable cost. The paint, that's a variable cost. But if you're taking the depreciation from equipment and dumping it into your cost of goods sold, or for that matter, other overhead costs, then you're mixing variable and fixed, and that may not be useful. Now, we never encounter it in this class, but this idea is important. Accounting information sometimes may not give us good financial analysis information. Period costs, things like selling and administrative costs, may be variable and fixed also. All right, when we come back, we're going to jump in and look at our cash flow identities. We're going to calculate all sorts of different cash flows that will help us look at a company and figure out what's going on. All right, we'll see you next video.